you very much. Let's see if I can. Is it working?
Yeah, it is.
Okay. Thank you very, very much for inviting me to speak here. I want to give you a small warning before I enter into the formal part of my presentation, and that is I moved to China about 7 years ago, and before I moved to China, I worked on Wall Street for many years in Latin America. I started my career in trading the old restructured debt in the 1980s, and I've spent my whole career on the bond side, on the fixed income side. And there's a saying on Wall Street that if you're an optimist, you should do equity. But if you do debt, you're a pessimist. And that's maybe because on the debt side, we really don't have upside, we only have downside. So we're always looking for problems. So I warn you that I'm always looking for trouble, I'm always looking for problems, and I'm deeply pessimistic about a number of things. Having said that, I do think, I quit my career and moved to China for 2 years, and that was 7 years ago. And I hope to stay there many, many years, because I think the Chinese story is a very important story, and I believe that today China is around 6 to 7% of global GDP. There's lots of talk about whether it'll be the biggest economy in the world or the second biggest economy in the world. That debate gets a little bit silly, but certainly it will grow significantly, and I suspect that by 2030 it'll be between 15 to 20% of global GDP. Now, I think that makes me a huge optimist. From 6 to 7% today to 15 to 20% within 20 years should get me labeled as an optimist. But for many, many years, I was invited to speak in every single conference in Asia because they needed an optimist and they needed a pessimist, and there were 1,000 optimists and there was only one pessimist. And to me, that indicates how insane some of the optimism was. If I'm a pessimist, what the optimists are saying are crazy. And those of us who are old enough to remember, I see one or two people are perhaps not old enough to remember Japan in the 1980s, sometimes I think the kind of things we hear about China today or until recently remind me very much about the kind of things we were hearing about Japan. So what I would like to talk about is maybe I can title it The End of the Asian Development Model. And I want to describe a little bit what I think the Asian development model is and what I think the engine of the Asian development model is. And then I will argue that China is the Asian development model on steroids. It's a super version of the Asian development model. And I believe that those days, the days of that model, are over. And I'll explain why. But first of all, let me explain what I mean by the Asian development model. There were two very important components to that model. One of it was a number of policies engineered at raising savings. We often hear that Asians have a cultural propensity to save, and that may very well be true. Ethnic Asians in the United States tend to save more than the average American. But in addition to, if there is a cultural propensity to save, there were a number of policies that were very specifically aimed at increasing savings. And one of the consequences is that the Asian development model, the countries going through that process, tended to have very high savings. Now, of course, raising savings means constraining consumption. So one of the aspects of the Asian development model was high savings and low consumption. Another aspect of the Asian development model was a massive channeling of resources into productive facilities, into manufacturing, and to a lesser extent, infrastructure. And these two policies were often the very same policy. For example, one of the conundrums in economics has always been the very low interest rates in the Asian tigers and in China. Interest rates have been extremely low in China for many, many years. And this has a double impact. It has an impact on savings and it has an impact on production. It has an impact on savings because in China, unlike in the United States and in Brazil, as interest rates go down, the average Chinese household saves more, not less. And I'm always asked, why is that the case? And I don't know. One hypothesis, I think, is because in the United States, most people save in the form of real estate and stocks and bonds. So when interest rates go down, their wealth increases, and they feel they can spend more out of current income. In China, very little savings occurs in that form. Almost all of it occurs in the form of bank deposits. And so when interest rates go down, Chinese feel less wealthy. In particular, since they save so much, interest income is an important part of total household income. So declining interest rates cause Chinese to increase their savings rate and, of course, reduce their consumption. It also has an impact on production, because very low interest rates make it very, very profitable for companies to borrow and to manufacture. There was a recent study done by the Hong Kong Monetary Authority on the rising profitability of the state-owned enterprises in China. Many of us have argued for a long time that the state-owned enterprises are inherently inefficient. And yet, and they're not very profitable, but profitability has been rising very, very quickly. And the people at the Hong Kong Monetary Authority asked a very simple question. To what extent is the profitability of the state-owned enterprises a reflection of very, very low interest rates? So they made some exercises to raise interest rates, not to natural levels of interest rates, whatever that is, but simply to the same level as other Chinese corporations, corrected for leverage and corrected for profitability. And what they found is that if you did that, it explained 100% of the profitability of the state-owned enterprises. When I think about trade policies, it's not just currencies and tariffs that affect trade. Anything that affects the difference between production and consumption has a trade impact. And very low interest rates are as effective as lowering the currency in boosting production and ultimately in boosting trade. So you have a number of policies like that. It was very difficult to raise wages. In fact, wages as a share of GDP have declined through the entire decade. It was the currency, of course, has been significantly undervalued. Many people say that in the last 5 years, since 2005, the currency has appreciated. It hasn't. It has appreciated against the dollar. On a trade-weighted basis, it's actually depreciated slightly. And if you include the differential increase in productivity in China, productivity growth in China has been higher than productivity growth in the U.S., the currency is even more undervalued today than it was 5 years ago. So you have a number of these policies, all of which constrain consumption and boost production. So what does that mean? Well, as a matter of sheer arithmetic, if production exceeds consumption, you must run a trade surplus. And with production growing much faster than consumption, you must run a growing trade surplus. And in fact, that's been characteristic of the Asian development model, high and rising trade surpluses. But there's a problem. If you're going to run a large trade surplus, somebody somewhere must run a large trade deficit. And who is that somebody somewhere? Of course, it was the United States for a bunch of reasons. Maybe Americans have a cultural propensity to consume. Again, I'm always nervous about the cultural arguments, but certainly it's not hard to convince Americans to consume. But more importantly, I think the flexibility of the financial system in the U.S. and the flexibility of the economy made it the only place where a significant increase in trade surpluses could be counteracted by a significant increase in trade deficits. And in the last 10 years, we saw something very interesting that happened. As China significantly increased its exports and increased its trade surplus, the tradable goods sector in the United States necessarily shrank. And the U.S. had to respond in one of two ways. It could have allowed unemployment to go up, in which case we would have seen rising unemployment and slower growth in the United States, or it could have lowered interest rates in order to keep unemployment at whatever the acceptable level was, in which case we would see consumption in the United States grow faster than GDP. And in fact, the Fed chose the latter process. It kept interest rates low, and U.S. consumption grew much faster than GDP. This was probably exacerbated by a number of other things, and I don't want to talk too much about the U.S. Because I'm not an expert in the U.S. economy. My focus is on China, but I'm impressed by the fact that whenever the U.S. has had an unpopular war, it has also had a stock market bubble and a credit bubble, for example, in the 1960s during Vietnam. And I think the explanation is that the U.S. does not like to fund unpopular wars the correct way, through taxes. It funds it through monetary growth and borrowing, all of which increases underlying liquidity. So I would characterize the last 10 years as a locked-in system in which both the U.S. and China were locked into this relationship. And I speak mostly about the U.S. and China because the truth is most of the trade surpluses in the world were accounted for either by the OPEC nations or by China. And 2/3 to 3/4 of the trade deficits in the world were accounted for by the United States. So it really was a system between China and the United States, which some people call Bretton Woods II. If you eliminate those two countries, the global imbalances were actually very, very small. If you include those two countries, the global imbalances reached levels that had never before been reached. So they were locked into a system in which rising trade surpluses in China cause expanding monetary growth. Because as you know, China has a currency regime. It doesn't have a monetary policy. Basically, the PBOC must buy the net inflow of dollars. And it became a self-reinforcing cycle because as the PBOC bought dollars, it created renminbi, either renminbi or central bank bills, which in China are an almost perfect substitute for money. And so it created money to purchase dollars. The money went into the only functioning part of the financial system in China, which is the banking system. So this money growth created credit growth. And in China, there is very little consumer credit. There were some attempts at expanding consumer credit that went really, really badly. There is almost no lending to the service sector, and there's almost no lending to small and medium enterprises. Most of the lending goes to state-owned enterprises, who are manufacturers. So as China had a trade surplus, it had an expanding monetary base, which was channeled by the banking system into the production sector, which meant production increased more rapidly, which of course meant the trade surplus increased. So China was locked into this cycle of rising trade surpluses leading to rising trade surpluses via the monetary side. At the same time, they had to recycle the currency. They had to recycle these rising trade surpluses, and they did so by purchasing dollars. There's been a big debate about whether they should have been purchasing dollars or SDRs or euros. I believe that entire debate is nonsense. China had no choice but to purchase dollars, and it still has no choice but to purchase dollars, because where China recycles its currency determines who is going to run the trade deficit. And I do not believe the only other country large enough, Europe, I do not believe that they are structurally able to run large trade deficits for long periods of time, able or willing. So basically, to the extent that China is running a large trade surplus, it must purchase dollars, and it did purchase dollars, and that huge amount of money was recycled into the U.S. Again, I will remind you in the 1980s when the U.S. trade deficit with Japan, mostly because of Japan, went to 3.5% of GDP, we also had the Great Bubble, which culminated in the trade deficit in 1986 and in the crash in 1987. I think of that period as sort of a mini dress rehearsal for what we're going through now. So we have these two countries locked into a system of high and rising trade surpluses on one side and high and rising trade deficits on the other. And high and rising trade deficits in the United States meant that consumption had to grow faster than GDP, and that also meant that debt levels had to grow. Those are all arithmetical equivalences. And as we know, debt levels grew. In fact, debt levels grew to levels that we had never seen before. Even in 1929, when we had seen the last really massive increase in U.S. debt, we vastly overextended it from 1929. And now we have the crisis. And the way the crisis occurred, frankly, to me was a surprise. The fact that it occurred was not a surprise at all. In 1996 and 1998 and in 2002, I wrote articles about how the liquidity cycle normally ends and what are the typical processes of it, and it filled the pattern very, very closely. But it did end, and it has ended. And what does that mean? Well, this is something that we can debate, but it seems to me that one of the key things that we can count on for the next several years is that the U.S. has to resolve its excess debt. That debt has to come down. And as debt comes in, it can come down via higher savings, repaying debt. It could come down via the bankruptcy process. There are many ways that it will come down. It will probably come down through all of those processes. But as it comes down, that means that U.S. consumption must grow slower than U.S. GDP. And if U.S. consumption grows slower than U.S. GDP, or if U.S. consumption grows slowly, U.S. GDP is probably going to grow slowly. I'm not smart enough to tell you what I think U.S. GDP growth will be over the next 3 to 4 years, but I suspect it's not going to be very high. And remember that U.S. consumption will be below that. And if it is, there's a couple of things that will happen. One very important thing is that the U.S. trade deficit must come down. And I will remind you, the last time we had very high and worrying trade deficits in the mid-1980s, they reached 3.5% of GDP. Last year, they doubled that. So we are, in the United States, we've had a trade deficit that's never before been matched in peacetime, and it must come down. It is not sustainable. In fact, there are some people who argue that by next year the U.S. will run into a trade surplus. And I'll remind you that in the beginning of the 1990s, after the Japanese experience, the U.S. also temporarily ran trade surpluses. Now that may sound like a good thing, and in some ways it is a good thing because we needed the adjustment. But make no mistake, that is going to be one of the most painful processes that we can go through. And the countries that are going to suffer the most are the countries, the high trade surplus, high savings countries. Why? Because it was the ability of the United States to absorb these massive trade surpluses being generated through the development model in Asia and especially in China that allowed that development model to continue. If the U.S. sees a declining trade deficit, and if nobody replaces the U.S., and I don't believe anybody can, Europe is in even worse shape than the U.S., Japan is even worse shape, and nobody else is big enough, that means that we have a problem. In China, we produce more than we consume. And somehow we're going to have to balance. In the past, we simply exported the balance. But if we're no longer able to export the balance, it has to be resolved domestically. And how do you resolve it domestically? Well, there are two ways you can resolve it domestically. One way, of course, is to raise domestic net consumption. The other way is to reduce production. The former is the good way. The latter is a very, very painful way. I will remind you that in the 1930s, in 1929, the U.S. was the world's leading trade surplus country. It had very high savings rate, and it had the highest reserves ever accumulated in history. Sounds very familiar, right? When people tell me that China can't have a crisis because it has huge amounts of reserves, I always tell them the United States had huge amounts of reserves in 1929, and clearly it could have a crisis. It won't have a currency crisis, of course. It'll have the very old-fashioned 19th century overinvestment crises. And that's what the United States had. And how did the U.S. resolve this excess of supply over demand? Oh, by the way, I always like to give a couple of numbers. The United States in the 1920s had the highest trade surpluses in history. They amounted to something like 0.5% of global GDP. China's trade surpluses are around 0.6% of global GDP. So they're a little bit bigger than the U.S. trade surpluses. The difference is that China is around 7% of global GDP, and in the 1920s, the United States was around 36%. That gives you a sense of how incredibly high these surpluses have been. I don't think we have ever seen anything like this before in history. Surplus is so high as a share of GDP for a large economy. So it's got to be resolved. In the United States, we tried to resolve it very, very cleverly by interfering with trade. If the Europeans were no longer buying our excess production, we had a great idea. Let's divert American demand away from European goods towards American goods. And how did we do that? We did that with the notorious Smoot-Hawley. We raised tariffs. And it was a great idea as long as nobody noticed. Of course, everybody noticed, and there was significant retaliation, and global trade collapsed by around 70% in 3 years. Now, this is very important for trade surplus countries. One of the things that I don't like to say too publicly is that the trade deficit countries weren't hurt too badly by the 1930s. It was the surplus countries that were most badly hit because the collapse in trade meant that they had to resolve the imbalance domestically. And Keynes argued, of course, that the United States should expand fiscally as rapidly as possible to create new demand. Easier said than done. For better or for worse, the U.S. didn't do it, so it resolved it the other way by closing factories and firing workers. And of course, when you do that, consumption is going down, so you're chasing a declining consumption. And it was a very brutal adjustment for the United States. So what will China do? Well, in China, we've been talking for many, many years about the need to adjust the development model away from an export orientation towards a domestic consumption orientation. Well, I have several problems with that argument. Problem number one is that other countries have done it. The United States did it. Believe it or not, it used to be primarily an export-driven economy until the beginning of the 19th century. And then because of a crisis in England and the Napoleonic Wars, it was forced to make the adjustment. It was a very difficult process. It took about 2 decades for the U.S. to make the adjustment. Japan, one could argue, after 1990, has also been in the process of making that adjustment. And I don't need to tell you it's been very long. It's probably not over, and it's been very, very difficult. If you look at the historical precedents, no country has been able to move from a primarily export orientation towards a domestic market orientation in a few years. It takes at least a decade, and it's always a very difficult process because you simply don't have a factory that makes bicycles and sells it to America and then say, okay, make something to sell to the Chinese. It doesn't work that way. The way the transition takes place is the export-oriented factories go bankrupt. They release the resources and the labor, and it's slowly transformed towards the domestic market. So the first problem I have with this argument that China will simply raise domestic consumption is that never before in history has anyone been able to do that quickly and easily. And I see no reason to believe that China will be any different. The second problem I have with that argument is that it was over 5 years ago that there was a complete and total consensus in the Chinese government that China needed to make the shift. It had to become less reliant on exports and more reliant on the domestic economy. Everybody agreed. There isn't a single member of the State Council or of the Standing Committee who would tell you that that was the wrong path. Everyone agreed it had to be done. What happened in the last 5 years? Domestic consumption has declined as a share of GDP sharply. Exports has grown as a share of GDP, and the trade surplus has surged. In other words, China over the last 5 years, when there was complete consensus, actually went backwards. Chen Deming, the Minister of Commerce, recently wrote an article in which he said that we should get great praise for how successful we've managed that transition, even though, he said, no one should expect the transition to happen overnight. Well, many of my Chinese friends were very cynical about those comments and said, of course we should praise them, because if we don't praise them, we'll get in trouble. But they moved exactly backwards. One of the misconceptions people have about China is that there isn't a ferocious debate. There is. There is a real debate in China, and it's a very interesting debate, and pretty tough. So they haven't been doing it, even though they've said that they've needed to do it. It's difficult for anyone to do it. The historical precedents are very, very tough. So what about the current policies? Isn't China boosting domestic demand? No. It's boosting the wrong kind of domestic demand. The kind of demand that China needs to boost is net demand. That is, it must boost demand faster than it boosts production, because it must get rid of that overcapacity. And that's not what China is doing. The trade surplus in the first quarter of this year was significantly higher than the trade surplus in the first quarter of last year. China is boosting demand by boosting supply. What do I mean by that? Rather than channel money into the service industry or into small companies or into consumption, almost all of this massive expansion in lending has gone into the state-owned sector and into manufacturing. So as a consequence, manufacturing is growing at least as rapidly as consumption, because the way they're defending consumption is by not closing a factory. They don't have to fire workers, and of course if you don't fire workers they can consume, but they are producing more than they're consuming, so they're not resolving the excess production problem. In fact, they are talking about expanding and taking on more market share in the export economy. Their goal is to increase their exports while the trade deficits are coming down. If trade deficits are coming down, trade surpluses must come down, and they are coming down. But more than 100% of the reduction in trade surpluses has taken place among other Asian countries or other competitors to China. I don't think that's sustainable. I think it will lead to trade war. What else can we say about the process in China? They're expanding total demand, but they're not expanding net demand. They're expanding total demand by increasing production. There are some really telling anecdotes. As many of you know, one of the things that has boosted the economy in China recently has been this massive expansion in lending. Total loans in China as a share of GDP are extremely high. But in the first 3 months of the year, total loans went up by 15%. That is, in March, the total lending books were 15% higher than they were in December. That means loans are growing at an annualized rate of around 75%. This has really been the thing that's boosted the Chinese economy in the short term. But how has it done it? Well, the biggest single borrower is AVIC. AVIC is an airline parts manufacturer. They borrowed $35 billion, about 5% of the total, a little bit more than 5% of the total increase in lending. The chairman was interviewed on Bloomberg, and he was very proud of all the borrowing he did. And he said, now the most difficult problem we have is deciding what to do with the money. When you borrow $35 billion, generally you should have an idea. But that's what's happening in China. The demand for expanding loans is so great that people are borrowing money without any clear idea of what they're going to do with the money. There are rumors, and these are fairly plausible rumors, that we're going to find that in the month of April, aluminum production, China is one of the world's largest producers of aluminum, aluminum production went up 10% in 1 month. Now, the world is awash in aluminum. We don't need more aluminum. But they expanded it. Why is that? Because the biggest aluminum producer is Hunan province. Unemployment was going up rapidly, so they channeled tons of money into the aluminum factories to reopen them in order not to fire workers. Now, it's true you don't want to fire workers, but if they're doing it by expanding the production of aluminum in a world in which aluminum demand is contracting rapidly, what are they going to do? Either they're going to have to push out all other aluminum producers, or they're going to run into rising inventory problems, and eventually they're going to have to close the factories down. There are more stories like that. One of the chairmen of the steel companies, as you know, we have too much steel. He was quoted by Bloomberg as saying, "You can never go wrong by investing more." Well, in the last 30 years where you had this very rapidly rising U.S. consumption, that may have been a good strategy. Produce more. The Americans will buy it, right? But if they're no longer going to buy it, I think that strategy no longer works. So the whole country is focused on expanding production as a way of dealing with the crisis. By the way, this is what they did in 1997-98. There was an initial slowdown. They pumped money into these state-owned enterprises, increased production, so they didn't suffer a slowdown. But there was one big difference, and that is the United States was growing at 4% a year back then, and U.S. consumption was growing much more quickly. And when you think that at the time, the Chinese economy was about 1/6 the size of the U.S. economy, it was very clear that with that kind of growth in U.S. consumption, they could pump stuff out and the Americans would buy it. I think those days are over. But there's something else that worries me a lot, and that is the Chinese banking system has not been marketized, it has not been commercialized, it is not independent. There was debates about that for years. I was always very skeptical that any real change had taken place in the banking system. And in the last 4 months, when everybody in the world is contracting their loans, when foreign banks in China are contracting their loans, the Chinese banks, claiming to do it for commercial reasons, expanded their loans by 15%. To me, that's clear evidence that the banks are policy banks. They are lending because they were told to lend. Fine, that's not a problem. But there is a problem that comes out of that. The credit culture in the banking system in China is very, very weak. And to me, it is almost a matter of certainty that we're going to see a significant increase in non-performing loans. Now, some people say, who cares? So we get non-performing loans in the future, but we boost employment today. That's more important. We'll fix the non-performing loan problem like we did the last time. The last time means in the mid-1990s, mid to late 1990s, when non-performing loans surged. They may have been as much as 40 to 50% of GDP. And China resolved it a number of ways. It resolved it in part by transferring money to the banks. It resolved it in part by, and this is very important, by keeping both the lending and the deposit rate extremely low. How did that work? By keeping the lending rate low, and they were very explicit about it. The PBOC said this many times. By keeping the lending rate low, they would slow down the accumulation of non-performing loans because they kept the interest costs very low. By keeping the deposit rate very low, they would ensure that the banks were extremely profitable so that they could get profitability in order to work their way out of the non-performing loans. And of course, there was a third thing that they did, and that is when you're growing by 10, 11, 12, 14% a year, 40% of GDP today becomes 20% of GDP in a very short period. They grew their way out of it. If we get another explosion in non-performing loans, what will happen? Well, they won't be able to grow their way out of it, I think. I may be wrong, but I think the days of 10% plus growth are over. Growth rates are going to be much, much slower. But what I'm particularly worried about is how they recapitalize the banks. Because they're going to recapitalize the banks, they're going to keep deposit rates very low. Both of those things constrain consumption. The recapitalization constrains consumption because basically either via taxes or borrowing, they will corral savings and give them to the banks. But the other way worries me more. If they keep interest rates very low, remember, when interest rates are low, Chinese increase their savings. So we're sort of caught in a problem. And the problem is, in order to resolve to the U.S. slowdown, we're pumping up production and pumping loans into the system. We are significantly increasing capacity, and we are probably increasing future non-performing loans. I believe that the U.S. will not be able to absorb that excess capacity, and I don't believe anybody else will be able to. I also believe, because of the rise in non-performing loans, Chinese consumption will not grow nearly as quickly as we hope it will. So we're left with a problem. Massive overcapacity that is probably going to get worse before it gets better. But ultimately, we are going to have to resolve it. And I would argue that the resolution of that is going to be slow and painful, and it's going to result in what I would call a lost decade for China. But having said that, a lost decade for China is not 0% or 1% growth. It's much better than that, 4 or 5% growth. China will continue growing faster than the rest of the world, but the days of 10 to 14% growth are well and truly behind us. I think I've said a lot of different things, and I'm probably running over my time.
No,
so I thought, I'm not.
Okay.
How much more time do I have?
15 minutes.
15 minutes.
15 minutes.
Okay.
Okay.
One of the other topics that always comes up, maybe there's interest here, maybe there's not, is this issue about what to do with the reserves. So I want to discuss that a little bit. When Hillary Clinton came to China a couple of months ago, she begged the Chinese, please keep buying our treasuries. And I was furious. How could she be so badly advised on economic issues? Well, I think we know why. The process of confirmation has been so difficult in Washington that there's nobody there. One of my bosses who had worked at the U.S. Treasury has been invited to be Undersecretary of Treasury. I think I'm the only American who hasn't yet been invited to be Undersecretary of Treasury. And he's declined for the same reason everyone else has declined. He doesn't want to go through the confirmation process. And so there are problems with the quality of economic advice. But the reason I was so angry at this was because there is this perception you often hear that China is Washington's banker. No, China is Washington's grocer, or America's grocer. It does not lend money to the U.S. as a discretionary lending decision. It doesn't have a pile of money and says, let's see, who should we lend it to? It's running a trade surplus. It must recycle that money. It has no choice. If they stop recycling it, the value of the renminbi will shoot up 30 or 40% and exports will collapse. They must recycle it. If they recycle it to Europe, they will cause the euro to strengthen against the dollar, and they will force the U.S. trade deficit to migrate to Europe. I'm half Spanish, or I'm half French, and I was born in Spain, so I have a lot of European in me. And my impression is that politically and economically, Europe cannot possibly absorb a trade deficit of that size. So that's not an option. So they only have one option left. They must recycle it into the U.S. And as long as they have a trade surplus, they will continue buying dollars. Now, many of my friends who should know better tell me, this is terrible. If the Chinese stop buying U.S. treasuries, how will the U.S. government fund itself? Well, first of all, during an economic contraction like we're seeing now, interest rates never go up. The U.S. government will have no trouble funding itself, I don't think. But secondly, if you're worried about the Chinese funding the U.S., I can solve that problem tomorrow. All we need to do is buy huge amounts of Chinese goods and stop selling them goods, cause our trade deficit to go up to 10% of GDP. And all of that will be used to purchase U.S. treasuries. Would that be good for the United States? Of course not, because the trade deficit, the larger the trade deficit, the more the U.S. has to borrow to pump up the economy, because the employment impact bleeds out through the trade deficit. In fact, ideally, the United States should be running balanced trade. But if it's running balanced trade, that means that foreigners will not be buying U.S. treasuries, by definition. If foreigners are recycling capital into the United States must be running a current account deficit. If it's got a balanced current account, there will be no foreign recycling. So this whole issue of whether or not the Chinese will want to fund the U.S. Treasury is a completely nonsensical issue. They have no choice. And it would be better for the U.S. if they didn't fund the U.S. Treasury, because that would mean that the U.S. trade deficit had collapsed to zero. And, of course, a collapsing trade deficit is expansionary for the domestic economy. I want to get that off my chest because I get into so many arguments about that. I've spoken to people at the People's Bank of China, and they understand that. They find it bizarre that anyone should ask them to fund the U.S. Treasury, but it's become a political football, and they're not allowed to say anything, because even in China there's the sense we can decide not to fund the Treasury. And the PBOC started telling them that if we make that decision, our exports collapse. But they stopped making that argument because the PBOC is very much out of favor now and has received a huge amount of criticism domestically. So it's one of those things that no one really talks about except the press, and the press gets it completely wrong. Oh, I'm sorry, the People's Bank of China. After 7 years in China, I don't even call it the central bank anymore. It's the Central Bank of China. So anyway, this issue of whether China will finance the U.S. fiscal deficit is a non-issue. It doesn't exist. The only way China could stop doing that is by a collapse in its exports, or by forcing the trade deficit onto Europe. When Governor Zhou made the famous SDR comment, and for those of you who don't remember, just before the G20 meeting, he said that the problem with the world is the position of the U.S. dollar as the reserve currency, and if we eliminated that and replaced it with SDRs, we wouldn't have these great global imbalances. To me, that was a very surprising statement. And I spoke to my friends at the PBOC, and they all said, it's nonsense, don't worry. So even the PBOC didn't believe it. But why is it nonsense? It's nonsense because if China wanted SDRs, it could accumulate SDRs. It's very easy. The SDR is an accounting unit. It's 44% dollars and 56% yen and sterling and euros. They could easily do it, except they can't do it. Why not? Because if they start accumulating fewer dollars, remember what that means. That means that the U.S. trade deficit must migrate over to Europe, Japan, and England, countries that simply don't have the capacity to absorb it. They accumulated dollars because it was the only way they could run massive trade surpluses. Without it, they couldn't do that. And Governor Zhou understands that. Nobody else in the leadership seems to understand that. Anyway, I think I've thrown out so many things that perhaps if I open it up to discussion, we can follow whatever may be of interest.
Thank you.
Thank you.